A discussion of central bank operations and interest rate policy by Warren Mosler and Phil Armstrong. A closer look at the Fed funds market. Mosler's 2012 further analysis of the operation of the Fed funds market incorporates additional bank behavioral assumptions vis-a-vis the standard corridor model, adding aspects of the interbank market which are absent from the sanitized conceptualizations exemplified by the Bank of England, 2010. Mosler's analysis of the Fed funds market might be considered to be a real-world system-wide macro-analysis of the banking system. Bank reserves are entries on the Fed's books that can be entered only by the Fed. When the U.S. banking system is left collectively short of reserves by the Fed's activities, the required reserves in the first instance are overdraft loans from the discount window. Window borrowing, however, is considered to be a sign of financial stress and weakness. Mosler's analysis recognizes that because of this stigma, the Fed funds rate can exceed the lending or discount rate even when banks do have sufficient collateral. As banks collectively bid up the Fed funds rate, the spread between the Fed funds rate and the discount rate widens to a point where banks decide that borrowing at the Fed funds rate is so costly that the stigma associated with borrowing from the Fed is acceptable as an undesirable byproduct of lower-priced discount window borrowing. This is shown on the diagram below. As the market rate exceeds the discount rate beyond point A, banks at some point borrow the needed reserves from the discount window. The Fed acts passively, setting price and not quantity, and supply adjusts to demand, eventually satisfying all demand at market equilibrium shown by point B, at a rate above the discount rate. Ultimately, however, the bank's reliance upon discount window borrowing is always under the control of the Fed. Fed provision of additional reserves via open market operations also determining price, in this case by using a stop yield for repo rates, allows banks to reduce their need to borrow from the discount window. Footnote 5. When central banks conduct repo auctions, they ask the dealers to offer collateral in competition with each other, with the lowest yields awarded funding up to the highest yield the central bank decides to accept, which is called the stop. End footnote. Conversely, if the Fed provides fewer reserves than the banks wish to borrow using open market operations, the spread between the Fed funds rate and the discount rate will widen, requiring banks to rely more heavily on stigmatized discount window borrowing. The unprecedented increase in the level of bank reserves supplied by the Fed in the aftermath of the global financial crisis generated, as matter of policy, a systemic excess supply of reserves. The excess supply, S, over demand, D, would have driven the Fed funds rate to 0%, had not a floor rate been introduced by the payment of interest on reserves held by banks at the Fed, shown by the deposit rate on the diagram. We next point out the MMT Perspective, Mosler, 2012, of the debate between accommodationists and structuralists within post-Keynesianism. Footnote 6. Paulin, 1991, contrasts the two approaches to money supply and endogeneity, the accommodative and structural, and provides a clear distinction between the two. The accommodative perspective argues that no quantity constraints exist on banks with respect to reserves, as the central bank must necessarily supply required reserves. Only a price constraint is relevant, as the central bank acts as price setter. The structural perspective contends that attempts by the central bank to control the growth of non-borrowed reserves do exert quantity constraints on banks. Additional reserves, although they may not be fully adequate, can be generated within the system itself by liability management. End footnote. What MMT recognizes is that the argument is moot. as loans not only create deposits, but at the same time create associated reserve balances, all as a matter of accounting. Footnote 7. For MMT, lending is best thought of as the bank purchasing the note from the borrower, and then crediting the borrower's account for the proceeds, thereby establishing funds that did not previously exist. This view is consistent with the general case where any bank purchases established, create incremental, new bank deposits. End footnote. This means there is no choice to be made by the central bank with regard to adding or not adding reserves, as a reserve deficiency is a loan from the central bank, and in fact accounted for as such if overdrafts are not resolved by settlement day.